Is a 10,000 gross profit good? Is a 10 million gross profit good? Is a 1 billion gross profit good? Should you invest in a company for this achievement? It's actually unclear if the company has performed really well or not. You cannot really tell if a number on an income statement is good or bad unless you compare it to something else. This view is also held by Warren Buffett, the world's greatest investor.
Well, what I'm trying to do as I read reports, I like to understand just generally what's going on in all kinds of businesses. If we own stock in a company, in an industry, and there are 8 other companies that are in the same industry, I want to own or be on the mailing list for the reports for the other 8 because I can't understand how my company is doing unless I understand what the other 8 are doing. I want to have the perspective of, in terms of market share or what's going on in the business or their margins or the trend of margins or all kinds of things that I can't get unless I know. I can't be an intelligent owner of a business unless I know what all the other businesses in that industry are doing. And so I try to get that information out of a report.
When you analyze an income statement metric, there are 3 types of comparisons to consider. Comparison number 1, compare the figure to a previous time period. Comparison number 2, convert the figure into a percentage of revenues. Comparison number 3, compare the figure to similar companies in the industry. One way to assess the financials is by comparing a number from the current time period to the same number from a previous period. If you are running a lemonade stand that made $5,000 last month and $10,000 this month, your sales increased by 100%. This gives you helpful information and shows you a trend. Are revenues increasing or decreasing? Is operating income increasing or decreasing? Keeping an eye on key metrics to track the trend is key when you are monitoring financial numbers. At first look, you might think, whoa, a 100% increase in revenue from one month to the next is amazing. In many cases, doubling sales can be a positive thing. However, is it always true? It's possible for your sales to jump from $5,000 to $10,000 in one period, but your company could still go out of business shortly afterward. If your lemonade stand is not making a profit, meaning that for every cup you sell you lose money, maybe sales doubled, but your company's losses grew significantly. In this specific situation, sales increased, but profits decreased. Although comparing a financial metric from one time to another is helpful, it doesn't give the full story. You need to compare a metric in the income statement to some items on the same statement for the same time period. Whenever you get an income statement listed in dollars, euros, pounds, or any other currency, it's important to convert every number into a percentage of sales. When you express an income statement as a percentage of revenues, you can easily compare 2 businesses, even if they are different sizes. If you compare your lemonade stand to a competitor and you have an operating income of 50% while they have 30%, that tells you something important. You are keeping 50 cents in profit from your operations for every dollar of revenue you make, while your competitor is only keeping 30 cents. When you express operating income as a percentage of sales, it's called operating margin. When you express gross profit as a percentage of revenues, it's called gross margin. Once you have converted items into percentage of revenues, you can compare them among different companies. Every industry has standards that you can use to compare your company's financial performance. Comparing gross profits as a percentage of revenues between 2 companies can show you how efficiently a company produces its products and whether it can charge higher prices for them. Let's compare the gross margins of Apple and Dell. The first 2 columns display the first few lines of Dell's and Apple's income statements. The last 2 columns represent Apple's business's 2 segments, selling physical products and selling digital services. The first thing I'd like you to notice is the difference in the gross profit percentage between Dell and Apple. Dell has a gross profit margin of 20%, while Apple's is a remarkable 45%. Other than saying that Apple's number is more than twice as big as Dell's, what does this actually mean? When Dell sells something for $100, it costs them $80 to make it. Dell makes $20 as gross profit from that sale, and they need to use that money to cover all non-manufacturing employees and expenses. When Apple sells something for $100, it only costs them $55 to make it. So Apple has $45 as gross profit, and they can use that money to cover non-manufacturing employees and expenses. Remember, gross profit equals revenues minus cost of goods sold. Simply put, this shows that Apple can either sell products at higher prices compared to Dell and or make products more cost effectively than Dell. The first increases revenues generated per product, while the latter reduces cost of goods sold. Apple usually makes between 300 and 400 billion in revenue annually, while Dell's revenue is around 35 billion per year. Because Apple generates almost 10 times more revenues than Dell, they probably have significant bargaining power when negotiating prices with their suppliers. Additionally, Apple is known for selling its product at high prices, and its flagship iPhone is far from being the cheapest in the market. Now, if you look at Apple's two segments, products and services, there's even more to the story. Apple's product business makes a gross profit of 37.5% as a percentage of its revenue. Apple's digital service business, which include iTunes, iBooks, Apple TV digital content, and iCloud data storage, achieves a gross profit of 75% as a percentage of its sales. You can notice that Apple's service business boosts the overall profitability of the company. The gross margins tell a story. In this case, it shows that Apple can charge higher prices and probably enjoys manufacturing cost benefits. However, the numbers alone don't always answer an important question. Why Apple can charge premium prices and have manufacturing cost advantages? Higher gross margins indicate that a company likely has a competitive advantage, which enables them to either charge higher prices or secure lower costs from suppliers. Competitive advantage can come from a company's ability to charge higher prices because of its brand, the difficulty for its customers to switch to another provider, the network effects that customers benefit from, the absence of alternative for customers, or a unique secret the company possesses. A competitive advantage can also come from a company's ability to be the low-cost producer and provide the lowest prices to its customers. When a company maintains superior gross margins for years or decades, it doesn't just show that they have a competitive advantage. It shows that they have a durable competitive advantage.